Welcome to BizTech's Investor Conversation Show. Today we feature Jon Maier. He's the Chief Investment Officer, Global X ETFs. Now, Global X ETFs is a fully owned subsidiary of Mirae Asset Financial Group, which is a global industry leader with 51 offices and over 12,000 employees worldwide. They were founded in 1997 and is one of Asia's pioneering fund management companies, and now oversees over $500 billion US dollars in client assets. Now, with that, I want to welcome you to the show, Jon.
Thanks for having me on. It's a pleasure to be here.
Now, Jon, first of all, could you give us some perspectives? We've just entered the second half of the year. What are some key trends that investors should be aware of as we start the second half of the year?
Sure. First of all, I'm more US focused, but I can certainly talk a little bit about Asia. So I'm going to kind of start with the US and kind of shift towards where I see some of the trends for the second half of this year. First of all, this year largely has been driven, the rally globally has been a very narrow rally. In the US, just a handful of companies really have driven up the S&P and the NASDAQ, those well-known companies that we all know. And that's because of this AI story. AI has really driven a lot of the rebound from the drawdown of last year. And it's been narrowly focused in these companies because these big companies have what is needed for generative AI, which is data. Data is extremely expensive and important, obviously, in the generative AI space. And so interestingly is that you start with data, and then you kind of move to the cloud, and because you need to store this data, you need to protect this data, so you move to cybersecurity. And then obviously for the generative AI story, it's the semiconductor story that is really helping drive markets. That's what drove markets in the first half of the year, along with a very strong CapEx cycle. So in the US, we are in an earnings recession. But what's so interesting about this earnings recession is that the CapEx cycle is so strong. And that's because there's been this tremendous amount of underinvestment in companies over the past 10 years. And over the past several years, driven by certain trends like reshoring, because of starting with 2017, the tariffs imposed on Chinese companies, combine that with the pandemic and the wrangled supply chains, companies needing to invest in themselves, diversify, as well as improve efficiencies because of the lack of manpower that we are experiencing right now. And that all feeds back to this AI story and robotics story, which are some of the products that we have in my firm. So that's really what's driven the first half of the year. Is that going to take us through the second half of this year? Well, I do think that growth is slowing, both in the US as well as globally. But there are certain areas, regions that I think are really going to benefit in the second half of this year. One is India. I think India is emerging as an economic powerhouse. They have a lot of the foundations already set, the relationship already with the West, the political setup that investors aren't scared of. Obviously, the demographics, which are tremendous. So I think India in the second half of the year and beyond is an area that investors certainly should be taking a look at. In the area of monetary policy, the RBI hasn't been passive. They've been hiking its policy repo rate, and it's shown a commitment to steering the economy towards stability. So that's really important. And then there's just general optimism in the manufacturing sector, maintaining robust health and indicating strong growth in the future. So I think India is a place to be.
Jon, I want to interrupt you just a little bit here because I've got a couple of key questions. You've highlighted a key theme that doesn't come out in the media a lot, really that strong CapEx cycle. I got to bring you back to that.
Okay.
Do you see that continuing? And obviously that's going to help the US from a competitiveness standpoint and also to ride out any potential downturn because you've done that CapEx investment up front at this point of time.
Well, I do think it's going to continue. It's going to continue because these companies, first of all, have a tremendous amount of cash. So what's a good use of that cash? Investing in yourself to improve your efficiency, to prepare yourself for the demographics going forward, to prepare yourself for the changing business environment, to prepare yourself for higher interest rates, which we're experiencing right now, and I believe that'll extend for a period for a while. So yes, I do think it will reap benefits for years to come. And because of this, you have to remember there's some fiscal packages in the U.S. that certainly have kind of kickstarted some of this. The infrastructure packages, the CHIPS Act, the Jobs Act, a lot of this public money that's being spent. And whenever there's public money being spent, there's private money that's being spent. So the tangential private money that's going into that's being invested is tremendous.
So that multiplier impact is going to be significant moving forward. I mean, this is, I think, a theme that's not been talked about enough.
Without a doubt. And I think it's one of the things that's making this cycle completely different. So everyone's talking about a recession. The recession has yet to appear. I don't know if it even matters if there's a shallow recession or not. You certainly have had an earnings recession, which I mentioned earlier, which I think is, we're near the end of that earnings recession. But CapEx is certainly kind of a unique factor that's different from other recessions if we actually hit a recession.
Now, Jon, I want to go back then to the second point that you made around the India growth story. And the India growth story is playing out nicely. What do you see are the risks there? You've talked about the opportunities, but where are the risks there in the India growth story?
Well, markets have moved up pretty fast, so that's always a risk right there. But I mean, if you look at some of the fundamentals, and I hate to go back to the fundamentals besides the risks, but you look at, say, India's youth literacy rate, it's 92% for a population of 1.3 billion people. That's amazing. India has, is the largest supplier of university graduates in the world this year. They're projected to be the third largest economy. They have the third largest group of scientists and technicians in the world. So there's just a lot of tailwinds there. Risks, you never know what could happen politically. Historically, India has been a difficult market to access, although it's been easier. India jumped from 79th position from 142 in 2014 in the World Bank's ease of doing business. So there are a lot of improvements there. And
so
the
Jon,
demographic story is undeniable.
Are you one of those that is saying this? And I hate to interrupt you again, but you're obviously an India optimist. A lot of investors and investment gurus are saying that India looks a lot like China in 1990. Do you sort of share that view?
I don't think no, I don't share that view. India, its manufacturing sector's labor cost is roughly 40% of China's right now. So I also think the regulatory environment is so much different than in China. While there's certainly some aspects that it's more difficult to access the market in India, I do believe that it's easier to access in China. So
now the other thing in the first half of the year, the theme in terms of a country was that whole re-rating of Japan. Do you see that happening in the second half of the year? Continue.
I think so. I mean, for the longest time, Japan was a value trap, for decades. And this economic resurgence shows a strong post-pandemic recovery. You're seeing domestic spending. You're seeing this revived tourism, and a weaker yen. So that's certainly helping things. Social change, such as increased workforce participation, which I expect it to continue. Japan has this demographic problem, right? So that's why you see a lot of the robotics companies are focused in Japan, because they have to find other ways to improve their efficiencies. But you are seeing a higher degree of women participating in the workforce, which is a positive. Then the Japanese government is focused on wage growth, which is facilitating other labor reforms. And so they're trying to make this recovery sustained. So yes, I do think that there's legs on the Japanese story.
Now, before I interrupted you then, John, anything else in terms of key trends for the start of the second half of the year that we should be watching out for?
Well, I do think that there are risks. Now, in the US, short-term rates have risen 500 basis points in a little over a year. Now they're expected to rise 2 more times in July by 25 basis points, and in September by 25 basis points. So another 10% from 500. Will that change the paradigm? No. What I think is happening is that the 500 basis points haven't been fully realized in terms of their implications to the broader economy, both in the US as well as globally. I do think that we're starting to see like the PPI has come down to almost target to 2% in the US. Inflation is coming down. So those are all positives. Things in the US that are gonna remain sticky and high are wages, obviously, and housing. Housing is very strong, weakened a little bit, and then re-strengthened because there's very little supply in the US. You're seeing new homes being built at a very high rate, and you're seeing some of these home builder stocks just on a tear.
And so can you and this is a trend that I've noticed and we've discussed on several shows, but I would like to get your perspective on that. Despite the rising interest rates, housing starts are on a tear. Why is that? That seems counterintuitive.
So counterintuitive. It's one area that you would think would be so interest rate sensitive, housing, that what's going on? Well, you have to look at what's going on prior to March of last year. Interest rates were so low for so long. Everyone who had the ability to refinance at lower rates did. Anyone, the housing market was strong, but rates were low. So people locked in rates at, sub 3% for 30 years. So people are locked in these very low rates. I want to move, but do I want to give up my 2 3/4% interest rate mortgage? No. So what will I do? Maybe I'll add on to my house. I'll put a new kitchen in. I'll deal with my house in some way, shape, or form, but I'm not giving up that 2 3/4% interest rate. That's the problem that you're seeing right now. From my perspective, life marches on. People grow up and want to buy a house. People retire, they want to move to a different area. People die. So there's a natural course of life that occurs. So that's going to add inventory over time. Now, the US market is different than other markets. Say in the UK, for example, mortgage rates aren't locked in for 30 years. They're locked in for a short period of time, a few years. So in other markets, you are going to see a rolling off of these very low rates into higher rates.
And we've seen that already in Asia, with in places like Australia, in Singapore, where people want on hyper low rates, close, less than 1%. And now the resets are starting to bite the housing markets.
Yeah. I mean, once you double or triple your payments, that's a big thing. You buy a mortgage, you don't buy a house, right?
Yeah.
So at some point it has to catch up.
Now, John, I want to now look at from an investor lens then, given that macro picture that you've painted for the second half of the year and things for us to watch out for. Diversification, obviously, for an investor is a core principle of investing. What are the strengths of ETFs compared to other forms of investing?
Well, I'm an ETF guy, so clearly going to say how much I love ETFs.
Yeah.
ETFs are a way to diversify. So it's about, I'm going to get these numbers a little off, but about $7 to $8 trillion in the US, 10, $11 trillion globally in the ETF structure, and growing. And the reason it's growing so much faster than other investment products, it's the diversification, the transparency, the cost structure, and the tax efficiency, which is really important, particularly in the US. If you think about it, you buy a mutual fund, say in October at a really strong year, essentially you're buying yourself a capital gain. Excuse me, on the ETF side, that's not the case. Typically, there's no to low capital gains distributed by an ETF, and that's a huge positive. Now, the ETF market has gotten so broad and segmented that which I haven't talked about, I create portfolios at Global X, as I did in my previous job at Bank of America. You can use broad beta combined with more narrow focused exposure, like say themes, some of the themes I talked about today, robotics, artificial intelligence, cloud computing, cybersecurity, and use those as satellite exposures to enhance your kind of core exposure that you all can be done with several or many different ETFs.
Now, Jon, it's been a great conversation, and that's obviously something that we've got to pick up on a more detailed show around how to invest. Thank you very much for taking your time to be on the show.
Thanks for having me, and I hope to be back sometime soon.
We've been speaking to Jon Maier. He's the Chief Investment Officer, Global X ETFs. I'm Brian Fernandez, and you've been watching and listening to BizTech's Investor Conversation Show. This interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.